Hello, everyone. Dave Keller here at StockCharts.com. Thanks for joining us for this episode of The Pitch. The Pitch is one of my favorite shows that we do. It's about once a month that we bring together three experts trying to navigate these markets. I feel like the 2022 episodes of The Pitch, you need to put armor on before you get into the before we go live here with this. Because these are challenging times, but I have found that there's so much to learn from experts and knowledgeable practitioners on how they navigate these markets. Bull markets are easy, right? Bull markets are where everyone's a genius. This is where you really earn your keep and where there is great value in money management, in risk management, and in understanding how to navigate bull and bear cycles. So we have three fantastic guests today for you to help you make sense of things and give you just a little window into how they are approaching this market and where they may be finding opportunities given all the uncertainty. So welcome to the three of you. First off, Dave Landry, founder of DaveLandry.com. Second, Joe Rabil, president of Rabil Stock Research. And third, Jessica Inskip, director of education and product at OptionsPlay. It's great to see all of you again. You are the pitch veterans, but it's great to have this group together today. Welcome to all of you.
Thank you.
Thank you.
Joe, I'd love to, as we're just getting ready to sort of, talk about our pitches and everything, how challenging was this one in particular to come up with ideas during uncertain times?
Yeah, I think it has, for me, it just had more to do with the timing of it. Just because, to me, the trend is down in the intermediate term time frame. And, very clearly. And so I don't like shorting stocks when they're oversold, right? Mm. So it makes it tough, especially if the market's oversold, even if your stock isn't oversold. In fact, if your stock isn't oversold, it's probably been a good relative performer. So it just from that standpoint makes it tough. On the long side, there are some stocks that are holding up. But as the market deteriorates, we're losing more and more soldiers. It's like, they're just trying to hang in there and they can't. So I found it to be I don't know, I've done the pitch maybe 3 or 4 times. This was definitely I felt the hardest to kind of come up with.
Most challenging, right? Perfect. Perfect. Jessica, when you're looking at these, at just trying to come up with ideas, how did you think about the risk management portion? Because I think that's the challenge a lot of people face is just what kind of bets you're putting on. How does that play into your selections here?
Yeah, I've read a lot of actually really good research on really bear markets in the past and their peak to trough, and then securities within that peak to trough and how they've performed pre-bear market, during a recession, if that were to happen, and then post. And so that actually formulated quite a bit into my pickings, which is oddly a little more fundamental than usual. So from a risk management perspective, I think that's important, especially if we're shifting to stocks and not options. So we have more of a time frame we can account for because they don't have an expiration date attached to it. It was important from a risk management perspective to look at the health of the company. So positive earnings per share, positive revenue, if it's well positioned for the macro environment and the concerns that are leading to the overall bear market. So that was the way that I approached risk management, just from a security picking perspective. And then of course, just overall, the normal rules apply is not putting all your eggs in one basket, ensuring diversification. So I also try to be diversified with my picks as well.
Yeah, look, you've always done a great job, Jessica, about incorporating some of the fundamental characteristics. It'd be interesting to hear your comments, given that a lot of companies are becoming a little, more attractive valuations, certainly means by some measures as prices going down, earnings struggling as well with a lot of them as well, which we may get to. Dave Landry, you've been a regular on the pitch and always bring a great perspective to this. How optimistic, how good are we going to feel as we get ready for your first pick after you've dropped 5 ideas on us? Will this be a feel good the pitch or a challenging?
Well, this is going to be a challenging one, and I'm glad we kind of touched upon some of these things right before we went live. And one of the things I thought about, I'm like, first of all, that's why I was so late getting the charts and just like, what am I going to show? Obviously, I want to show something and just knock it out the park and look like a genius, but we're just not in that kind of market. So I figured maybe if I could teach a little bit on a couple of charts, show you some things that look decent, but I'm not super encouraged that I'm going to have the best pitch ever here, but it makes me feel good that everybody else is struggling a bit too. The oversold environment, as Joe touched upon, it's a darned if you do, darned if you don't. If you short it, then it bounces. If you don't short it, then of course it implodes. And it makes it really difficult. And probably the best thing you could do is sit on your hands in an environment like this.
So get us started, Dave. We have you up first, and we're starting with your chart of the S&P 500. What is this telling you about the environment here?
Yeah, and this is where I wanted to do a little teaching. This is the TFM 10% system, and this is the little green line you see is what I call the buy line, and that's simply 10% below the 50-week closing high, which you can see it's early, or I should say late 2022 in there. And my theory is if a market's going to go down 50%, it's going to drop 10% first. So that and the 50-week moving average, that's all I use for this timing system. And you get one close below those, and it's a sell signal. And earlier, we were talking about I was trying to figure out who had first told me about it. It's probably Charlie Kirk, but a guy by the name of Voya and Gayard, they wrote a paper where bad things happen. They were talking about the 200-day moving average. Well, kind of borrowing that line from them where bad things happen. Bad things happen below the green line, below the buy line that's in here. And you can see if you go all the way back to the left of the chart. And by the way, if you find a broker that lets you trade off the left of the chart, let me know. But you look at the pandemic slide, the first red bar down, you'll see right below the 50-week moving average and the 10% buy line. So that was your sell signal there, which got you out of a lot of trouble. And the theory with this system is to avoid the big, Ian McGafferty, he used to call it the diaper change moment, these huge washouts. And back in the pandemic was 30 or 40% after the signal. So hopefully, a word you should never use in this business, but hopefully we don't go down another 30 or 40% or whatever the case may be. But bad things happen below the buy line, and you can plot that obviously in ACP, and my plugin is free on that free plug and a free plugin. So, but yeah, I'd stay away from the market for now as long as we're below the buy line is the point.
Bad things happen below the buy line. It reminds me of one of my favorite quotes, which is all large losses begin as small losses. Great starting us off with the spirit of risk management.
Thank you.
Joe, listen, it's sorry, Jessica, actually, let's grab your chart second. Jessica, when we're looking at your chart number one, it's JBL. With the in the technology sector. What's your take here?
Yeah, so they actually reported earnings this morning. So that's where it initially piqued my interest. They are either super late in the earnings game or really, really early. They're on that in between, so not really tell, to be honest. They did really great. They had wonderful earnings. They actually even lifted their guidance, which is something that is certainly going to help move the market overall, is those guidance liftings from analysts and post earning reports. From a chart perspective, though, I do see consolidation forming on that top level there. It looks like that previous low around, what is that, the pre-April, I'm hoping that's where it's going to find support. Now, what's interesting about Jabil is, from at least a technical perspective, they had really great earnings, so they should have rallied. But because of the overall market, they actually, of course, did not. And that's where I was saying that study I was reading, actually, it was a couple of months ago, which was really important. Even companies that have extremely healthy earnings per share and extremely healthy valuations throughout that bear market style or those extreme times of volatility still experienced a downturn. And so that's why when you're looking with securities, it's important to utilize technical analysis. And that's why it's extremely important finding those levels of support. So since this security had great revenue and really great earnings this morning, I'm hoping it's going to find that level of support from its previous low in April, in which case it would be held and be a solid security. Aside from that, there are a couple of other factors looking for diversity. Like I said, that risk management, even though it's technology, a lot of their revenue comes from Apple offering their 5G services. It also is healthcare and automotive. So that's a revenue stream that is very, very diverse. And healthcare is a sector that tends to perform really well during bear markets. So due to the diversity and the support level found, Jabil is number one for me.
It's a lot of really interesting comments there, Jessica, which I'd love to come back to in the Q&A, particularly that idea that good companies with good earnings that don't follow through to the upside during earnings season is a great kind of bear market tell of sorts. Oracle, we had FedEx sort of popping up, but kind of stalling out very, very quickly. Joe, we are now to you. And again, thanks for joining us in a fascinatingly challenging week to pick stocks. You're starting us in the energy sector with LPI. What's the thesis here?
Yeah, I mean, after looking at Dave's chart, I'm glad I got to put along here. I one of the things I look at too is that 50-week. When that 50-week or 40-week, you can use kind of either one. When that rolls over and you're below it, it's really a tough environment. But what I'll say here is, so this LPI obviously in the energy area. Now, one thing I want to make certain that I get across is, if you notice, this has not been a really powerful energy stock. This is not one that's been running and running and running. And my feeling is it's a very crowded space. And everybody, anyone who's been using technical analysis for the last 10 minutes knows that this is basically the only sector that's in an uptrend. So it scares me a little bit from that standpoint. So I'd rather buy something where I think if the group or the sector is going to keep moving, it's a little on the earlier side, and that it can emerge out of this. So I'm looking at this where it's been kind of quiet, and you can see on an ADX basis, the ADX line has been low for a while, telling you it's kind of been dormant, and now we're starting to emerge out of here. Now, it's at a pretty critical point. I would consider this sort of set up, but it hasn't triggered yet. It probably needs to take out the high of this week, in my view, to really trigger in to be what I would consider to be a buy. And I know we're going to talk more later about the risk management, but so typically I'm looking for trends. I'm looking to try and find something that I can play over the next 3-6 months, even longer possibly. But right now, I would have a different management approach on something like this, especially because it's going counter to the general market. I would play with less, my position sizing would be less, and I would probably just try and make money, like try and get a leg to the upside, play it a little bit more conservatively, maybe, cut your risk down if you get a move in your favor, and go from that standpoint. But overall, the pattern is attractive if it can get back up above the high of this week. I like the overall look to it, especially with MACD and ADX.
Yeah, I mean, and it's obviously energy has been such an outlier relative to pretty much everything else year to date. A good example of that uptrend, as you mentioned, though, you're lagging behind some of those other names. Maybe we'll talk about a little later in the discussion portion. Dave Landry, we're back to you. We are staying in the energy sector, but different type of name here within energy. ARLP. What's the idea here?
Yeah, well, first of all, full disclosure, I do have shares here, and I actually have shares from 489. And I don't want to brag too much because it had been an easy market lately, but I think this one still has potential. It's a coal company, which you would think would be really out of favor, but it's still an energy. And when I bought it coming off the lows, it was looking really good. And what you have here is it's pull back a little bit below the 30 EMA. And that's something I want to talk a little bit more about in 1 second, especially when we get to Bitcoin. But the 30 EMA can be your best friend. And I did a presentation recently, and I call it Say Hello to My Little Friend, because it can really keep you out of a lot of trouble. Now, it has pulled back below it, but the longer-term trend, so far at least, knock on wood, is still up. So I think if we got back above that 30, it would be a new buy, and I think it'd be worth a shot. And like Joe said, I'm kind of in agreement with a lot of things that Joe says, but I think this is one that, even though it's ran quite a ways, I still think it has a ways to go. Some of the energies are just at such high levels now that they're at nosebleed and they're priced for perfection. And I have some concerns there. Now, I might be talking my own position a little bit, but it still looks pretty good to me, at least for now.
All right. So we have a second energy name to review. Jessica, your second chart. You are now the outlier. I'm declaring we've got energy defensives, and then Jessica boldly going tech and consumer. So start us off with your second pick here with NVIDIA. What are you seeing here?
I like NVIDIA quite a bit because it's a high beta stock. So it moves quite a bit. So it's something that's really great to trade options on as well. But that's not the trade that I'm going to be discussing today. I am hoping it, again, just like that same thought process with Jabil, is finding support. And I see that it's trying to find support from its previous lows, which is a good sign. So it's a little bit of a contrarian. What I do not like is anytime the MACD signal line crosses over, I do not, that's something I really, really am cognizant of anything that I'm going long, just because that's uses an exponential moving average in the calculation. So it is forward looking. So that can indicate more downward movement. So that's something I'm going to be extremely cognizant of. But when you're dealing with stocks, remember, they there is no expiration date, so that there is something a little different there. NVIDIA, though, is different from their previous earnings call. So just going back to the fundamental aspect of why I like this security. One is the momentum just from all the traders that really like to trade this, to the chart finding support from the fundamental perspective. They actually are very focused on cloud computing, and they shifted all of their management focus over to that data source. And that is a primary source of revenue for them that helps with margins. And anytime you're entering into a high inflationary environment and we're thinking about interest rates going up, that is going to hurt margins of companies. So someone who has a larger profit margin, or management is shifting focus on that, is going to equate to better earnings. And so that's the other reason why I chose NVIDIA. Tech sector, that may be the first to bounce. So I also am seeing this type of market as an opportunity as well.
It's a really interesting thesis. And it's funny, NVIDIA is one of those names that reminds me of, Microsoft, Apple. We have a lot of these that have a similar kind of pattern, right? Sort of that bounce and now retesting the lows. I feel like when I think about the market at the precipice, those are the charts I'm watching to see if we're able to hold those or not. Let's see what actually plays out. Joe, we're at your second pick, which is a short pick, Voya Financial, VOYA. What's the idea here?
Yeah. So as I mentioned at the beginning, this stock has actually held up pretty well. I mean, relative strength is great in a bear market until it's not. It's once we start to lose the trend, then I think the relative strength follows. I don't know that relative strength is always a leading indicator. So this to me felt like something like water building on a dam. It kept on coming down to this level and trying to bounce off, but couldn't get anything going. And then again, I'm always watching for where ADX has been low for an extended period of time, because I know it's building energy for a move. Now, it could have broken to the upside or to the downside, either one. I'm just kind of sitting back and waiting for it to take place. And you can notice the MACD is also crossing down through the zero line. So frankly, I put these shorts out with the thought that we might get a little bit better rally before they actually take out the lows. Like I thought, we said yesterday, it looked like, hey, maybe we're going to actually be up for a couple of days, but it didn't work out that way. So this is almost a little oversold into the breakdown. I'm not a huge fan of that. It's from the daily chart, which I'm showing a weekly, but on a daily, it actually looks a little oversold. So it might end up coming back up through that breakdown level and then re-breaking a week or two down the road. If it plays out that way, I actually think that's a better entry. But, all in all, this is a weak stock that looks like it has some risk to it.
Yeah, good example. But what a great, just long-term consolidation pattern potentially resolving. But I love your comments, which we'll come back to later, about balancing the weekly versus the daily, different time frame with some potential different timing embedded in it. Dave Landry, back to energy, XLE. What do you see here?
Well, what I saw was it looked a lot better last night than it does today. So getting back to the challenging thing, when I was right before the show, I was resubmitting some charts or helping Dave work with them. And as I'm looking at them, going like, boy, they don't look as good as they did last night. But yeah, this one's pretty ugly. It's actually pulled back nearly too far. So that has to be a little bit of concern. Some of these energies might be priced for perfection, as I said earlier. But I think that if we could, in this case, I guess back above a 30 would be your magical line there. Once again, longer term uptrend remains intact. The at the bottom of the chart, just FYI, this is Landry light, and all that is lows are greater than the moving average. It doesn't measure the magnitude, but it measures the number of days. And if you go back in time, obviously in this chart, you can see we've had some nice little breakouts and then pullbacks to the moving average and nice little continuation of trend. So that's sort of what I'm looking for now. If it stays below the 30 much longer, I would begin to become concerned, and it could actually set up a short pattern, which I call a bow tie. So it's now more at an inflection point. It was kind of a pullback coming into the show. Now it's at more of an inflection point. Should it go straight back up, then yeah, it'd be worth a buy. But for now, maybe just sit tight. And as we were saying earlier too, about the only good looking area right now is the energies. And unfortunately, based on today's action, it's starting to become a little bit of the last of the Mohicans. So we're going to have to pay attention to what's happening there. But the the bottom line is if you wait for an entry, not all the time, obviously, but many times, in other words, wait for this to rally above the 30, just like the ARLP, it might keep you out of trouble. And I'm often amazed at how many times it will keep you out of trouble just by waiting for that entry. Many times I'll recommend a stock and 6 months later I'll get a complaint from a client. I'm thinking I've never recommended that stock. And then I go back and look and say, oh, I did recommend it, but it never triggered. And they got a little anxious and jumped in a little early. So a lot of times it's hard, especially if you're a little newer to trading, to wait for something to actually go up to buy it. Because in your mind, you're thinking, oh, let it go down. It's cheaper. It's a bargain. But there's a reason why it's a bargain, because nobody wants it, obviously. So definitely wait for an entry on anything that I recommend ever, and especially anything today for sure.
Absolutely. That's the environment. Landry Light, as you mentioned, Dave, is part of your free ACP plugin, which certainly encourage people to check out. Jessica, we're to your pick number 3, StarBucks. This is a chart that's been in a bit of a downtrend. What do you see today?
So if you notice, it's in its downtrend, again, looking for that area of support where it's hitting that low level that you're seeing on the chart. Additionally, I love a really good bullish divergence, which it looks like on the MACD from I see from the screen, as MACD is hitting higher lows and the chart is hitting lower lows. That indicates a form of divergence of some sort. And that's one of my favorite indicators to utilize in spot, in addition to the crossover with MACD. And if we see the same thing on RSI, then that's a solid divergence from my view. But again, you have to take into account the macro environment with this bear market. So that's extremely important. StarBucks is something that could be contrarian from a fundamental perspective, because we're really thinking about the consumer. And I think the first thing you're going to pull back when you look at your expenses is your addiction to Starbucks. I may not, because I need my coffee, but from that perspective, that could be a little bit concerning. However, Starbucks is really interesting when you dig into it and you listen to what the management says. So part of the main contribution to the inflationary environment is high energy cost and a really red hot labor market. So a lot of firms or companies have to raise their wages in order to attract more workers. And as that labor market still remains hot, that's something that could be of concern. And it's just very interesting that the balance that's needed for inflation, to put that correctly. Starbucks was ahead of the curve. They actually raised their wages a lot earlier and in comparison to their competitors, which means that inflationary pressure or that red hot labor market may not necessarily affect them, and their profit margins, like I was saying earlier, are going to remain intact, which is important from this type of environment. That health is very, very important. So I actually really like the chart on this one. It is a little bit that, mind you, that bullish divergence is a long-term divergence. It needs to find some support, and that needs to be confirmed. I would look for MACD to go right above that 0 line, and then we're good to go. But I actually really like this chart. I like this pick. I like the fundamentals and the thought process around it. Lots of good stuff here. Lots of reasons for this one, Dave.
No, it's true. And it's funny. I always describe people when I'm teaching them about sector relationships. Consumer discretionary are things you want. Consumer staples are things you need. By that definition, probably we might bucket Starbucks in staples with things you need, but I hear you. And it's a decent thesis given the divergence, which I hope we can have time to come back to. So that's an important topic, given the fact that so many stocks have been in downtrends here. Joe, your third pick is a short idea on Visa. What's the idea here?
So it's a similar concept to the Voya. It's another one. So this has been in an uptrend for like a gazillion years. It really has never truly broken down. Now, last year when the market was doing well, this actually dramatically underperformed on a relative basis. But then when the market started getting in trouble, it actually started acting better than the market, and it wasn't breaking down. But it actually looks to me like it's been going through a period of distribution. So we keep testing this area in the 185 zone, something like that. And it's another one where I would highly question shorting the breakdown if it happens right now. I would actually prefer if it either spends a little bit more time channeling, maybe bouncing back up to 200 first, or let it break down and then look to short a little rally, a failed rally back up, into this 190, 185 area, something like that. So it's at that point where I don't like shorting into an oversold reading. And when you're too far away from a weekly moving average, like I use an 18-week, if we're getting too far away from that line, it just feels like, I'm shorting and it's a little too late, which was the whole, conversation at the beginning here. But again, this is one where the relative strength has been good, but I think it could be starting to give way again. And you can see, again, look at the MACD, how it tried to get back up. You see how it tried to rally, and during this sideways consolidation phase, it actually failed at the zero line and started trending lower again. So I don't know. I think there's I think there's risk here. In terms of entry, I think you got to be spot on right now. You can't just put a trade on when you feel like it. I mean, you got to be really on your game right now. Because you can lose money very quickly, I think, in this environment.
Sadly, many investors probably have experienced exactly that, Joe, so far. But good words of wisdom there at the end. Dave, your fourth pick is TNK, back to the energy sector. What's the idea here?
Yeah, that's a shipper. The shipper seem to be doing okay at the moment. Longer term, just an FYI, many years ago, I did a lot of research where I was trying to figure out what markets trend, which markets don't. S&P futures was one that came up that does not trend, believe it or not, and the shippers were another one. But every now and then the shippers can really take off and really trend. It's just longer term, they don't. But anyway, same sort of concept with pulling back to the moving average. I call it Landry light pullback, where you have, if you look at the bottom of the chart, you can see we had about 25 days where it moved higher and it was pulling away from the moving average. Nice little pullback to the moving average recently. And then this one actually looks better than most of the other energies right now, if you want to call it energy. So maybe an entry around 21 or so, let it get back well above that moving average. Make sure that it's beginning to go back in the direction of the trend. Otherwise, just avoid it. And as I said earlier, with the energies at a bit of an inflection point, I think now waiting for entries is very important, and they might just fail. If they fail and don't trigger, obviously, then so what? And as far as you and Joe talking about risk, yeah, there's plenty of risk in this market. Jeez.
You mentioned Dave triggering a couple of times. That's something I want to come back to in our discussions. That's an important characteristic, right? You get a signal or you get the indicator, but then the trigger is something that a lot of people don't have the patience for, probably to their own detriment. Jessica, your fourth pick is Dollar General, boldly again remaining in the consumer discretionary sector. This is one that's actually bounced up off of the lows here. What is the idea here?
Yeah, this one I think is my safe pick, is what I'm going to call it. I do like the chart with this one. I think we're testing the cloud, and I hope we're going above it, but it's gone to that, back to that macro environment and the overall macro environment. So a lot of our retailers, Target, Walmart specifically, have excess inventory. They said it out loud, so I'm sure the others followed suit as well. That excess inventory is going to be slashed and on sales, and discount retailers like TJ Maxx, Ross, etc., and Dollar General are going to benefit from that. Essentially, and additionally, Dollar General, most of their revenue is come from consumables as well. So if we have a high interest rate environment and people are going to be shifting to the bare necessities from a really, really well-known discount store like Dollar General, then that can help with this type of market, and they will have better earnings. Now, contrary to the other things I've been saying, their profit margins are minimal and absolutely terrible. But that could change because of the vast majority. I believe it's 80% that is consumables. So if there is a shift towards that, then they could see an increase in revenue, which could certainly help those profit margins. But from a fundamental perspective, that's why I'm calling it the safe play and why it's reacted the way it has, and it hasn't fallen as much as the rest of the securities within the market, because it is a discount safe haven, if you will, for the consumer. From a chart perspective, MACD is above the zero line. It's trying to pierce through the cloud. So it's got that area of, I'm going to call it consolidation, where it's going to choose if it's going up or down. And I believe it's going to be up based on the environment.
Great take there. And thanks for some of the macro thoughts in there as well, Jessica. That's fantastic. Really, really well done. Joe, your fourth pick is Sierra Wireless, SWIR. What's the thesis here?
So I really should have zoomed out and maybe even shown a monthly chart on this. So, I mean, sometimes you just, when you're going through, and I know Dave Landry is similar to me, he looks at a boatload of stocks, and I look at a lot of stocks, and you go through a couple thousand stocks and look at a longer term trend, and you just kind of go, what is going on here? Like, why is this going up when everything else is pointing down? So it just caught my eye. But going back to, again, what Dave Landry said, which was, this might have good characteristics, but I don't consider it to be like there's no entry yet or trigger yet, because when we break out of this kind of a area, I wanted to test that area and then get back up. Something like Jeff Cooper used to call it the second mouse gets the cheese. So the first guy gets caught in a trap and then it comes back down. And then when you come up the second time, that's actually a pretty good entry. So that's kind of what I would be waiting for. If I'm going to go long in anything right now, I want to make sure there's confirmation from that standpoint. But it just kind of caught my eye. I think it's great stock to have on a watch list. And if we see some form of climatic action in the market, this would probably be one I would be taking a pretty hard look at.
It strikes me with both of those last two, as I'm bringing up, Dave, your fifth pick, is how those two names are ones that have actually done very, very well, while the rest of the market has been struggling, right? Stocks that are up while the average stock is down is always an interesting thing to consider. Dave, your fifth chart is Bitcoin. Yes. By any definition of trend, it certainly seems to be a negative one. What's the thesis here?
Yes, and getting back to let me see if I got if I have some great setups, or maybe I could just teach something in the process. In this case, once again, your best friend is the 30 EMA. And just because it's above it, if you look kind of back to February, March, and April, you can see it was above it, but it really didn't break out of the consolidation very well. And now, obviously, it remains in a bear market. It's well below the 30 EMA, and you have the Landry light once again. So if you go through Bitcoin and all the other crypto, you're going to find that 30 EMA can really be your best friend. And just one quick thought, too. It's amazing that people are putting out newsletters now and talking about how right they were about what crap crypto turned out to be, blah, blah, blah. But they missed the whole point. They missed the 1,600% run up before it imploded. And if you're using money management and trailing stops and all this other good stuff, you get to capture that piece of that move. And I was thinking, okay, well, I did really well in the .com until everything kind of blew up, and then you just get stopped out and you quit. And I read some of it. I haven't completed it. It's not the most exciting book in the world. It's called Devil Take the Hindmost. And it talks about all the bubbles throughout history. I'd recommend you read. It's not an easy read, but some of it's pretty interesting. And like the South Sea bubble, people made millions and millions and millions of dollars before it eventually blew up. And every other bubble in history is the same way. So as a momentum guy, I'm totally okay with trading bubbles. You just have to have a chair ready for when the music stops. And I think that the chair, so to speak, in crypto and pretty much any other market is the 30-day EMA, and just stay on the right side of that. That in and of itself will keep you out of a lot of trouble. And that's kind of my teaching aspect today, as opposed to my pitching aspect.
I feel like we're all educators in a bear market phase, Dave. So that's totally fair. Your fifth pick, Jessica, is Alibaba, the only really non-US stock that we're considering here. As I'm glancing through the names, what's the take here on Alibaba?
This one is more technical than fundamental, so I'm sure you're happy to hear that. But from just briefly on the fundamental piece, the Alibaba or anything in the Asian region was really suffering from those lockdowns. And so now that it seems like that's lifted, there's some room for the upside there, and perhaps they have gone down and already accounted for their activity that we're experiencing in the overall broader market. they've said on their earnings calls and from a management perspective that all of the bottlenecks that they experienced from those lockdowns should be resolved by the end of the month, which is fairly quickly. Shanghai and China do employ a lot of things to maneuver the market. So that's something to be cognizant of. From a technical perspective, I really do like this chart. If that isn't bullish divergence on MACD and RSI, I don't know what is. And it's really beautiful. And I love that setup. It's above the cloud. It's moving towards the end of its Bollinger Bands, and you can see how it does that. And I really do like utilizing those as well. And then to the moving averages, that smooth line that you see all the way at the top, that's its 200 daily moving average. So I believe that's going to be its next point of resistance once it hits that top of the Bollinger Band. So I see some upward potential there, and I'm hoping it goes above that 200 daily moving average and then finds support as well. Because remember, old resistance becomes new support once it's surpassed. So this is a beautiful chart. I love it more from a technical perspective, even from the fundamental side.
It's a great example, and it reminds me of some of the names I want to say, like FedEx or others that are starting to rotate higher while other things have struggled to do so. Interesting setup in any environment, but particularly when the average stock is certainly seeming to have trouble. Joe, your last pick is a short idea, and it's Kohl's KSS. What's the thesis here?
So another one where it was maybe a little hopeful that we'd get a little bit more of a bounce here. I would have preferred to have seen this actually come up a little bit closer to the moving averages, but a lot of times you can see the drop to the downside and the clear break of support. And when you do it that violently, with big bars and they're all red, there's a pretty good chance you're not going to make it back to the moving average. You're just going to make it back to the breakdown point, which is essentially what this is doing right now. Another one where we've got this low ADX pattern, but it's already broken down. And notice how the ADX is starting to move. It's crossing above my horizontal line, which is 25. And the red DI, which is the strength that basically telling you the strength of the sellers, has really started to expand here for the first time in quite some time. So I like that. I would just tell you in terms of trying to play the short side right now, it sounds really easy. Oh, we're in a bear market, just get short and you make a lot of money. And when it's over, you just collect all that, but I managed a hedge fund back in 2000. And I don't think I left my seat while the market was open for the entire year. It was so much work, and the moves against us when you're short stocks, the violence of the rallies and everything, it's not, you think it's easy, but my suggestion is play for single legs. If you haven't done it before, you might just want to use cash. But if you have, play for single legs, play with smaller size. If you can make money while everyone's losing money, even if it's a little bit, that's a major, major plus.
That was just a mini masterclass, or I guess on the dangers of shorting, Joe. That was awesome. Yeah. And I love everything you just said. We're going to come back to that in a minute, but I did want to review everyone's picks here just to recap what you guys have told us. We'll start, Dave Landry, with you. You had the S&P 500, sort of a negative start to the discussion. We then went to ARLP, Alliance Resource Partners, the energy sector, XLE, TNK. So three areas of the, sort of a focus on energy, different parts, shipping and coal, but all within the same sector. And then a cautionary tale of Bitcoin to finish off your five selections. Jessica Inskip, great job combining the fundamental and the technical in a pretty powerful way. We have five picks, really diversifying our group of stocks between the three of you, with JBL, NVIDIA, Starbucks, Dollar General, and then Alibaba, the fifth one, with sort of a different look from a lot of the other charts that we've been talking about today. Finally, Joe Rabil, great job with some long ideas and some short ideas, along with a beautiful, well-designed warning on the dangers of shorting. You have LPI to start in the energy sector, short idea for Voya Financial, VOYA, also short on Visa, and then Sierra Wireless, sort of the outlier within the technology sector, a tech name that looks really, really fairly strong, SWIR, and then shorting Kohl's KSS. So listen, guys, that was awesome in terms of your picks. I'd love to transition to the discussion portion here. We have so much to talk about. I filled the paper with great comments and thoughts that you've made. And I want to go through as many of these as we can with the time we have remaining. Dave Landry, I'd love to start with you. Obviously, this is Fed week, and the Fed's decision, which was yesterday, we're recording this midday on Thursday, the 16th, day after the Fed meeting and the minutes and everything. It didn't really, as far as you guys were saying, didn't really play particularly into some of the individual names, although the price action certainly reacted. What do you do in a Fed week? They tend to be noisy. There tends to be a lot of volatility. Is this the time where you lean back and just wait for things to settle down? Or do you see that as an opportunity to embrace the volatility and jump into the deep end? How do you approach this kind of week?
Well, with my core methodology, which is swing to intermediate term trend trading, like that ARLP, we've been in that for about a year and a half. I don't do anything different. And I let the database tell me what to do. And right now, the database is not telling me to do much other than those few little energy stocks in there. So nothing really changes with that. I try to ignore all news. I try not to factor in those things, although I might have a couple of questions for Jessica on some of the things that she said that were interesting. But for the most part, my mantra is don't confuse the issue with facts. The problem with, or one of the problems with my core methodology, which is the longer term trend following, or can be longer term trend following, if the swing trade works out, and we do that through the money management. But the problem is the occasional outlier is key. So if sometimes a client will call me up and said, I can't make any money. I'm like, did you get XYZ and ARLP and CPE or whatever, went 600%? They're like, no, but I got all those stinkers you recommended. So it's like, well, there's your problem, And so I can't really factor in the news and any type of world events or anything. I just have to stick to the technicals, and I have to stick with the charts. Now, on the intraday stuff, it's been all over the place. I try to do some of the stuff that I do that I've been doing for 20 years or more on the, I hate to even count anymore, but I've been working to do that on the intraday stuff. And that's been kind of brutal because the market has been all over the place. But every now and then you get a route. And if I could just figure out how to trade those route days, you'd never see my fat arse again, So, because that's when you can really, really print the money. So I would encourage people to sit on their hands if they're going to do something intraday until you see that route day developing where it just goes straight in one direction. And maybe we'll get that from this oversold environment at some point in time. So just circling back, for the most part, nothing really changes as far as the core methodology. Stick to it. You get a setup, take the setup. Don't go crazy bullish. Obviously, if the market is headed straight down, make sure you wait for entries. And as we discussed throughout, that in and of itself will keep you out of a lot of trouble.
Joe, it's interesting when we've done the last two episodes of the pitch. I think last time Jay Woods moderated it, but the time before I did it. And those, as far as I know, were the first two episodes of the pitch where anyone recommended utility stocks, which is kind of an interesting telling characteristic of the market environment. All of a sudden, people are pitching, boring utilities like Duke and Southern and others, but no real pure defensive plays that we talked about here today. No utilities, no consumer staples, unless you bucket Starbucks, of course, Jessica, in that one. But, so Joe, what are you, utilities in other areas have actually been doing pretty well here. Is that an overplayed out theme? And you just want to stick with what's working? What's your take there?
Utilities, again, they were playing well, and then they got hit really hard. I mean, look at the drop that just took place. So I think it really goes to the question of whether you're a professional investor or whether you're an individual investor. Okay. Because if you're a professional investor, you want to be as defensive as you can, or at least, if you're a growth manager, you can't own a bunch of utilities and defensive stocks. They just won't let you do that. But if you're lucky enough to be a value guy right now and you're overweighted in that stuff, you're going to have better relative performance. This is the way I look at it. And but if you're an individual investor, and you're looking for ideas, you have to have a process. Hopefully it's written down that you follow. And and I like a self-regulating process, meaning I go through and look at 1,000, 2,000 stocks in a week, and I'm saying, okay, how many stocks actually meet my criteria? Well, that list, it continues to drop every week on the long side. I mean, there just aren't as many stocks that meet the method that I would use for identifying good looking patterns. So I think if you're an individual investor, you have a big advantage over the professional investor. He has to be invested. He has to own something. At least a lot of the guys that I consult to. So,
yeah, Joe, you can't eat relative performance, and that's what the individual needs to realize. And just because you went down less in those utilities that are imploding, that doesn't put food on the table,
Yeah.
So good point on that.
It's a great point. What's funny is in my Fidelity days, we would literally say we eat the relative line, because we would pay less attention to price and more the relative, because that's how we were actually getting fed in the institutional side. But you're absolutely right, and that is a point really well taken. Jessica, when you made a number of good points, really combining sort of that relationship, thinking about the trends that you're seeing, but also the fact that these are companies with earnings, and ideally with earnings, but with a lot of other things going around. And particularly now, I'm thinking of, I mentioned things like Oracle and others, names that have had big jumps and have earnings releases. Can you just remind people that aren't as familiar with your work, how do you think about the relationship between the trend and something like earnings? Are earnings, when the company's reporting earnings, is that, similar to the Fed week, is that a time to take a step back and just wait to see how things play out? Do you have a process either with the stock itself or in the options market to try to play around the earnings date, or how do you relate those two?
Yeah, you've hit on really three great components to my process, which is the fundamental side, the technicals, and the options. And those are all really important. And I'll go back to the basics of technical analysis as well. And one of those is technical analysis assumes that the market is forward-looking, and I completely agree with this. And then it digests news as it happens, and so it corrects and adjusts accordingly. So you don't have to use all of those things. It's just with times with high volatility, you're kind of given a gift of knowing when those things are going to occur, like we do with earnings. We know there's going to be a large move from the upside or the downside. So what my process would be is number one, from a fundamental perspective, are they going to do well on those earnings? And there's two components of earnings. One is, are they just going to beat analyst expectations? How does the stock react when they do beat analyst expectations? And the second component from the fundamental perspective is, what is the forward-looking guidance going to look like? Because even if you have good earnings, the forward-looking guidance for the stock is going to go down. And it's important to know how the stock reacts to that. If it's something that's heavily traded and has a high beta, there's a lot of hype that goes into it. And even if they do well, it was really bought up, and then it needs to just correct and consolidate. And technical analysis is going to show you these same things as well, with the support and resistance levels that are defined by your indicators and momentum in your process. The options market, though, that's my favorite to use actually as an indicator for earnings. I never trade them because you experience something called volatility crush, where you're almost guaranteed to lose every single time. But what happens is the options market will actually price the anticipated movement. It's spot on a good 95% of the time, I'm going to call it. So you can actually see if the stock is going to move $8. It doesn't tell you which direction. You can see if there's a skew to either side, and really get an indication there. But I love to use those three when looking at earnings specifically. And then additionally, you can pull the same types of indicators on the overall broader market to get an understanding. And that's why, even if we're looking at the Fed raising by 75 basis points, when we were looking at that earlier this week before the announcement, there's probability models out there where you can pull based on the futures market. So actually, even though I'm speaking to fundamental aspects, they're very technically driven. What's the pattern? Are they higher? Where do they find support? How does the stock react? What is the spread and the futures market saying from a probability perspective? What does the options market say from a probability of which direction it's going to go? So there's just a lot of factors. And in this type of environment, and I'm going to quote one of Farrell's rules, which I really love from a technical analysis perspective, which is that bull markets are a lot more funner than bears. And that just simply means they're easier to trade. And when you're in a bear market, it's important to utilize all the tools and resources that are in front of you.
I love so many things you said there, and way to throw a Bob Farrell quote in the end. That was bonus points for that. I actually just tweeted out this morning a Bob Farrell quote, which is what's so funny about it. At the bottom, stocks will be cheap and no one will care. which is another good one for this sort of environment. It struck me, Dave.
One. Yes, it is.
Yeah. Dave, as you were talking, I made a note about the line, what I call the line in the sand. You talked about with some of your charts, sort of that level, whether it's the 30-day EMA or whatever it is, but sort of, the way I would describe it is sort of the level above which things are good and below which things are less good. Can you just talk about that general mentality and how that relates to your overall thinking?
Yeah, as you know, I like to keep things simple, and I don't know if you could read it, but it says trading simplified here, and I have that trademarked, and I try to keep it as simple as possible. And when I first did my presentations for the ACP plugin with something like the Landry light, green good and red bad, Tarzan speak, and sometimes, and I had a little Tarzan bounce around, you get bored, take a look at those on YouTube, but or StockCharts channel. But yeah, I mean, just even like looking at this T&K, which just happens to be up now, you can see when it's red, bad, okay, and below the average, and when it's green, in general, it's good. And I think it's good to have some sort of performance-based metric, and that's one thing that I've fleshed out in some recent Trading Simplified shows, is that the way I look at technical analysis is just performance-based investing. And it's like you're putting together a team. Let's say you put together a team of employees. You want the best employees. Somebody's not working out, you got to get rid of them. I mean, that's life. And for some reason, people can't wrap their head around that when it comes to stocks. They hold on to stinkers, and sometimes they get rid of the winners. But if you have some sort of performance metric, whatever that is, and like in that ARLP, I've got a trailing stop. That's a good ways away from the market because we've been in it for a long time and we let it gradually open up. But just something like that, or before you even get in, to say, well, I want to make sure it's back above the 30, or at least looks like it's going to cross above the 30, and some sort of thrust higher momentum before getting in. And just wrapping your head around that will keep you out of a lot of trouble. A lot of times I'll tell people, markets go up and markets go down. They look at me kind of funny. But once they're in the market, all of a sudden, if the market's going down, they start justifying why it's going down. So as I often say, unless you're Bill Clinton, what is. So always have a point where you're wrong and you just have to get out of the way. And on the flip side, don't try to catch that falling knife. Wait for things to rally before looking to get in, at least as a momentum guy. And by the way, the only way to ever make money trading is to catch a trend. So my feeling is, why not be a trend follower all the time?
I love that. Why not be a trend follower all the time? I absolutely love that breakdown. I'm going to write that down for next time. Just to finish off, Joe, it strikes me when you were talking about some of the energy stocks in particular. I want to bring up some of your names. What do you make of things like, just generally with the energy space? I think a lot of people are struggling with what to do with some of the names. Some of the leadership names, right? Things like DVN and others that have just been in these great uptrends. I know I've been asked all along the last 6 to 12 months, did I miss it? Did I miss it? Did I miss it? And the answer has been no. Like, it continues to go. But at some point, right, I arguably a real bear market, I would guess, means some of these energy names really have to come down a lot more than they have. But is this the type of chart that still is attractive to you, excites you, or is this the type of thing where you say it's gone up enough? How do you think about these kind of names in this environment?
Well, this is interesting. You bring up this stock, and you can see, because you're using my chart, it's a 18. You see the 18 week there is the line that it keeps bouncing off of. And you notice how it has more like a 45-degree angle to it. It's not accelerating away from the line. It keeps moving up and pulling back, moving up and pulling back in a pretty orderly fashion. And we know that's the case because the 40 underneath the blue line is moving up at about the same rate. We have like parallel look to it. As long as you have that kind of parallel look and the price action doesn't skyrocket away or accelerate away from the purple line there, the 18 week, I think you can keep playing the trend. What'll show up if it starts to accelerate and start to do some wacky stuff is the MACD won't confirm, the ADX might do some things, but you can see it in the price action. You can see it in the moving averages if you know what you're looking for. When those two lines are parallel like that, you're in a really, really strong trend. The problem I've got with what's going on in energy in the short term is that you can see there was a gap on this one. If you go to a daily chart, we've had some gaps. We've had multiple gaps in some of these stocks off these highs, and you've also had some volume expansion. Look at the bottom. I've got a 50-day moving average of the volume. We've had 3 distribution days in this stock out of the last 6. So, when I see something like that in a stock that's been going up, up, up and away, it makes me a little bit, do I want to buy a pullback to the 18-week? I do. But what helps me is using the 2 time frames. So I've got a weekly chart that's telling me to buy a pullback. But if the daily doesn't get me in on a trigger, then I will never get in. I would never enter the stock, even though it's set up. This goes back to what Dave was talking about earlier. I mean, if it's set up on the weekly chart, I got to wait for the daily to trigger me in. And if it doesn't trigger me in, then I'd never get long. So that's kind of my safeguard in this situation. And so if it triggers again, then I kind of have to take it. If I'm following DVN and it's one of my charts and I'm saying, you know what, I want to get long this. If this turns up and triggers on a daily chart, then I have to get in.
That was fantastic, Joe. I love the description. Great point on the volume. I hadn't really thought about it. I don't look at volume as not enough. And you're reminding me as we wrap up the Q&A, guys. What I appreciate so much about moderating something like the pitch is I get to hear from 3 of you who really know your stuff, apply your craft in a way that we can all learn from. This has been a blast. An hour goes by quick on the pitch. I feel like time evaporates, and I wish we had so much more time to go through because there's a lot of market wisdom you guys all shared with us, and I really appreciate it. So thanks to each of you for a fun time today.
Thank you, David.
Enjoyed it.
Thank you for having
I want
me.
to appreciate it very much. All 3 of our guest experts. We have Dave Landry, founder of DaveLandry.com. He's also the host of Trading Simplified on StockCharts TV. Does a great job with that. Joe Rabil is the president of Rabil Stock Research, also the host of Stock Talk with Q&A, where he'll field your questions on particular tickers, so look that up. Jessica Inskip is the director of education and product at OptionsPlay, a frequent guest on StockCharts TV, and really illustrates beautifully the relationship between the technical and the fundamental. You can go to StockCharts.com/thepitch for all of our previous episodes and to review the picks that you saw here today. See what our experts have been saying over time, help you navigate these uncertain markets and uncertain times. For StockCharts.com, I'm Dave Keller, Chief Market Strategist here at StockCharts. Have a great one. Hang in there. We'll talk to you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.